What we think is pretty important today is identifying opportunities that offer visible, predictable, and attractive cash flow growth. In particular, opportunities that whether you have a hard landing or whether you have a soft landing, it might not really matter. Because from a bottom up standpoint, there's a real interesting earnings growth story, fundamental improvement story that's happening, but particularly also good valuations.
Hello and welcome to the REIT Report. I'm your host, Sarah Vauxhall-Keto. My guest today is Todd Kellenberger, REIT Client Portfolio Manager at Principal Asset Management. Todd is here to share his insights into how REITs are likely to perform amid changing macro and monetary policy backdrops. Todd, welcome back to the podcast.
Hello, Sarah. Thank you for having me back.
So, Todd, REITs were benefiting from greater investor confidence about interest rate cuts well ahead of the Fed's September 18th move. Do you see that momentum holding for the remainder of 2024 and into 2025?
Yes, I'd say yes, we do. We believe the most likely scenarios for the U.S. economy ahead are either a soft landing or a mild recession. In both those scenarios, we see supportive conditions for REIT markets. Importantly, we're likely to see future rate cuts, perhaps a bit more in a recessionary environment and a bit less in a soft landing environment. But of course, with the soft landing, you're going to have the offset of a better economy. And in those scenarios where interest rates are coming down and the attractiveness of defensive, durable type cash flows that real estate provides, we see support for those stocks and we see still good momentum ahead. Now, the momentum of 16% type of quarterly returns that we saw back in Q3 are probably not sustainable. And I'm sure there'll be some bumps along the way as interest rate cut expectations will need to be recalibrated. But overall, the general trajectory of where markets are headed is favorable for real estate. The Fed is seeking to ease monetary conditions to avoid the hard landing, and that will importantly bring down the cost of capital for real estate and likely bring a recovery to property values. Since 2022, REITs have just been in this big correction because of capital markets. Cost of capital has gone up because of higher yields, and now that is reversing.
And Todd, besides monetary policy, what do you see as the main determinants of REIT performance going forward?
The economy, of course. How will demand and supply conditions change depending on those scenarios of soft landing or recessionary environment? Now, the one thing is with real estate is we have a decent read on supply. We have good information on permits and start activity, and the signals are very positive for REITs in that construction levels are likely peaking now in 2024 and maybe 2025 for a sector or two, but overall, really starting to come down now on a go-forward basis. So that's going to be pretty beneficial for the ability for REITs and landlords to continue to hold occupancies or grow those and push rents. How much will depend on the demand side of the equation, and that's going to be more dependent upon the economy, and particularly the job market. However, the good thing for the REIT market is the diversification across property sectors means there's a lot of sectors and REITs that have structural factors driving that demand. Now, some is a positive, like technology changes for data centers, wireless towers, or demographics for other sectors like, say, healthcare. Or there's a headwind, of course, for office and like work from home. But that'll mean performance leadership within REITs is going to be likely pretty varied, and sector and stock picking will be important. The other determinants, I would say, for REIT market performance going forward would be to what extent we see continued rotation into the REIT market from the generalist equity investor, as then those investors are likely to look for, call it more cheap, defensive exposure. And the REIT market is pretty underowned by a lot of those types of investors at the moment. So that could be a positive for REIT markets. The other thing that could be a positive is capital flows back into the space and the kind of the resumption of transaction market activity. Property transaction markets have been so depressed and muted the last couple of years because of what's been going on with interest rates and the overall market environment. We're starting to see maybe some signals that things are going to start to pick up as investors are starting to anticipate the recovery of real estate values. And should we see good transaction activity, assets for sale that REITs are going to buy, and importantly, prices start to clear at pretty attractive values, that could be a potential tailwind for the REIT market as well.
Great. And given recent outperformance by REITs, how do their valuations compare to the broader equities as well as private real estate?
We see relative valuations still looking pretty attractive. If we look at the REITs versus the equity market, particularly say looking at US REITs versus the S&P 500, we look back over about a 20-21 year time series of measuring the spread between the earnings price multiples of these two markets. And currently, the price multiple of the REIT market is about 40% below the long-term average spread of where it trades relative to the S&P. And to put that into context, That large of a discount means that only about 11% of the time have REITs been this cheap relative to the equity market. Or in other words, we're still at pretty historically cheap relative values for REITs versus the broader equity market right now. So that's pretty supportive, we think, in terms of owning REITs right now relative to equities. If you want to look at it relative to the private real estate market, we think that's pretty attractive too. In particular, we would point out the cap rates of which you can buy based on the implied cap rates of the REIT market of which you can buy today versus where appraisal cap rates are for, call it, the private market funds in the private market. So if we look at NCREIF appraisal cap rates for many of the NAVs on overall private equity funds, and particularly those core funds, those cap rates are still very low, about a 4.7% cap rate on average as of the end of Q2. Whereas where we were at the end of August for the US REIT market, the implied cap rate was about 6.3. So there's, in simple terms, there's still a big spread. And we think, a big advantage in terms of the valuations of buying real estate today in the public market relative to those legacy private equity funds, which are still playing some catch up with respect to their appraisal cap rates. Now, what we don't know, we have a less of a read on, I should say, is where are spot cap rates in the market for private real estate today. Those are probably somewhere in between the two. And that'll be determined as we start to see those transaction markets happen. And so can you deploy capital into real estate today? We think so. You could do so more attractive with the public market. Spot markets in terms of buying fresh assets today are probably also looking attractive, but we caution investors still today that a lot of those NAVs on private equity funds are still probably reflecting yesterday's real estate prices, not tomorrow's real estate prices like the public rate market is.
Besides valuations, what are some other reasons that investors might want to look at REITs today?
I think one thing is you always have to consider REITs, importantly, for the diversification that it provides, particularly what does real estate provide to diversification to a 60-40 portfolio of stocks and bonds? Because real estate is that other third major asset class, and the public REIT market offers it in a very attractive, efficient, liquid wrapper. Now, let's put that into context, though, for today. We know that equity markets have been driven primarily by a concentration of a handful of stocks, the Magnificent Seven, particularly the technology market. Where REITs offer diversification to that is, in particular, the exposure of which they have to declining yields. And declining yields are going to be helpful for a lot of things out there. And overall, is when interest rates go down, your discount rates go down, and the value of those future cash flows go up. But for real estate, those cash flows are often fairly fixed or at least fairly predictable in nature. And so owning something that should do well in a falling rate environment and provide good defensiveness like real estate can offer, and particularly public REITs can offer good diversification today, probably relative to a broader equity market that has been really fueled in terms of higher valuations from the enthusiasm towards AI and technology. That diversification looks attractive. In other words, is frankly getting good old brick and mortar exposure to physical assets right now versus maybe some technology trends. Not to say that those stocks aren't going to continue to do well. There's good reasons for it. But we like that diversification that REITs can always provide to that portfolio. I think the other thing is just to kind of emphasize again, the typical defensive, longer duration cash flows that REITs have that could look pretty attractive, particularly if one was in the camp that we're going to probably have more of a recession and a harder one at that. You have to look at the stability that REITs can provide in that environment overall as another reason to want to invest in them today.
Todd, looking at REIT property sectors, what are the attributes you think investors should be paying close attention to in the current economic situation?
What we think is pretty important today is identifying opportunities that offer visible, predictable, and attractive cash flow growth. In particular, opportunities that whether you have a hard landing or whether you have a soft landing, it might not really matter. Because from a bottom-up standpoint, there's a real interesting earnings growth story, fundamental improvement story that's happening, and particularly also good valuations. Take the healthcare sector, for example, in particular senior housing. The demand for senior housing is primarily driven by demographics, and particularly the age 80 and older part of our population, which, by the way, is expected to grow at about a 4.5% CAGR over the next few years. Contrast that with the supply market, of which is likely to be around 1% or lower for the next couple of years as well. So you have a great demand versus supply and balance story there today. At the same time, you have affordability that's improving because of the net worth of aging baby boomers has improved as equity and housing values have gone up. You're also looking at trough fundamentals. Occupancy loss was significant during the COVID era for senior housing. Rental rate concessions were happening between the REITs and the operators. Labor market shortages and costs were also pressures. A lot of those troubles are in the rearview mirror. So this is a good example that it's not as dependent necessarily on Fed markets, not as necessarily dependent upon the economy. And yet there's a really attractive runway for growth there. And so again, it goes back to where can you underwrite real estate assets that offer very predictable and attractive cash flows? And that's a good example of one area of which we see within the REIT market.
Great. And Todd, any other trends or developments related to REITs that you'll be watching in the months ahead?
Yeah, I think an important thing would be, do public REIT management teams take the signals of where their valuations are today to go and grow? Because the REIT market has been on a rally and private real estate values haven't recovered as much, you actually are seeing public REITs trade at premiums to the estimated NAVs or net asset values of these companies. And when that happens, some investors think that's a concern. They may be trading at premium valuations. I think there's really two signals that are being delivered there. One, the public market is saying we think real estate values are going up in the future, and stock prices are reflecting that anticipatory nature of that. But also, two, the public market is giving signals to these REITs that you have an attractive cost of capital, probably likely below that of which you can go transact at if you can find assets today. We could see public REITs coming to the market using their ATMs or doing secondary offerings for issuing stock, maybe looking to build up a bit of reserve of cash to go on the offensive for transactions. In anticipation that transaction activity in 2025 will hopefully be better than what it was in 2024. And that could be another lever of which then REITs can pull to potentially grow earnings, grow their asset base. And we hopefully, for the good managed, higher quality REITs, that they take those signals and hopefully can identify some accretive acquisitions.
Excellent, Todd. Thank you so much for your time today.
Thank you, Sarah. Appreciate being on today.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.